Short selling, what Tony was walking me through just a minute ago, is a common investment strategy used by stock traders to make some money in a pinch.
All right, and you may remember the GameStop stock craze of 2021. That was a serious case of short selling. So here's a quick lesson about how it works. Short selling is, and I'm learning along with you here, dear viewer, is when a trader borrows a stock or security from a lender and then sells the stock. Then the trader buys back shares of the stock from the proceeds from that sale, ideally at a lower price. That is a complicated graphic. I apologize for that. They should make a profit with what's left over after paying back what was borrowed from the lender. You got that?
Well, if not, you can subscribe to our graphics and look at it closely.
That's a five-step, three-icon chart. That is not easy.
That who you're seeing on screen is Matt Wirz, who joins us to help guide us through what short selling is. He's a reporter for the Wall Street Journal, which specializes in finance, not what we do here.
No.
Is short selling a good strategy to make money on markets, as I just teased, for people who want to make money in a pinch? And if you can walk us through a little bit more, what does it mean?
It's all a pinch, right?
Well, yeah, I would say to your viewers, just think of short selling as betting that prices are going to go down. That normally when you invest, you're hoping that prices go up. And short selling, well, that graphic was accurate. It's a little complicated. Just think of it as betting that prices are going to go down. And so short selling is it's another way to diversify your portfolio. Prices don't always go up. And recently they've been going down quite a bit. So this is a good way to make some profits off of that. And it's something that professionals and individuals have been doing more over the last 12 to 18 months.
Yeah, now that's simple enough.
That's simple. But so, Matt, if I make a big bet on a particular stock going down and it instead maintains or gains, what happens to me?
Right. So, it's not good. The same thing can happen when you go long, right? You can bet that a stock is going to go up and it'll go down. The difference is that your losses are potentially much greater when you're short selling. And you reference the GameStop kind of meme stock thing. If you're short in a situation like that where you get squeezed, the losses are potentially quite high. That's why most professional investors and individuals should follow suit. I think they treat this as part of their portfolio. It's not the only thing you do. You just do it to balance yourself out and make sure that you're protected.
In the context of Puerto Rico's debt and Puerto Rico's economy, which is where I'm from, I perfectly understand how short selling affects the fate of a nation. But let's talk about companies. What happens when short selling takes place to the companies that are being traded?
Well, so that's a good example, and I covered Puerto Rico. So, you did see some short selling in Puerto Rico, but I would say, and you might argue with me, is that in situations like that, the short sellers, while they may be moving prices in the short term, no pun intended, what the data shows is that they actually don't impact prices in the long term. And so they're somewhat scapegoats. So they might, for example, a bank, say like First Republic, if there were some shorts on the stock of First Republic recently, that did move prices down maybe more dramatically than they would have moved otherwise over the course of several days. But the eventual fate of First Republic really wasn't the result of short selling. It was a result of the problems that they had in their depositor base and on their assets. And in Puerto Rico, I would argue that it was kind of the same situation.
We'll invite you for a longer segment on that one. Matt Wirz, thank you so much.
This has been great. If we do that intro again, I'm going to read it with much more confidence.
Sounds good. Thanks, guys.
Thank you.